Welcome to Lesson 2 on Value Added Tax. If you haven't watched Part 1 yet, please review that before continuing with this lesson. By the end of this unit, you should be able to account for value added tax in the General Journal. You should also be able to recognize VAT transactions involving inventory under both the perpetual inventory system and the periodic inventory system. Further, you should be able to recognize other miscellaneous transactions involving VAT. And finally, you should be able to prepare the VAT Control Account. The process of recording transactions involving VAT in the General Journal is similar to recording other transactions. This will be illustrated using the following examples. The first transaction involves recording the purchase of inventory. The scenario reads as follows. FAC, a registered VAT vendor, buys trade inventories from NAST Ltd, also a registered VAT vendor, and pays cash for the goods on 1 June 2020. The purchase price on the invoice is 9,775 Namibian dollars. You are required to recognize the transaction in the General Journal of FAC for the month ended 30 June 2020 using the perpetual inventory system and also using the periodic inventory system. Under the perpetual inventory system, each time inventory is bought or sold, the inventory account is affected. In this instance, we are told the purchase price is 9,775 Namibian dollars. This amount is inclusive of VAT. We know that this amount is inclusive of VAT as it is a standard practice in Namibia to list prices inclusive of VAT. If the question does not specify whether an amount is inclusive or exclusive of VAT, assume that the amount is inclusive of VAT. Since the amount is inclusive of VAT, to calculate VAT, we have to use the VAT fraction formula, whereby the VAT amount is equal to R divided by 100 plus R, whereby R is equal to 15% as this is a standard rated supply. Therefore, in this instance, the VAT amount will be the purchase price times 15 divided by 115, which gives us an answer of 1,275 Namibian dollars. To find the exclusive amount, you can deduct the VAT amount from the purchase price, or you can use the VAT fraction formula whereby the exclusive amount is equal to the purchase price times 100 divided by 115. In this instance, the VAT exclusive amount is 8,500. After doing the calculations, we can then record the journal entry. Since we're dealing with the perpetual system, we debit trade inventories with 8,500 as inventories are assets. We debit input VAT with 1,275 Namibian dollars because this is a VAT on purchases and also because input VAT is an asset as we can claim it back from the receiver of revenue. Finally, we credit bank with the total purchase price of 9,775 Namibian dollars as bank is an asset, and in this instance it is reducing as a result of the payment. The journal entry under the periodic inventory system is similar to the one under the perpetual inventory system. The only difference is that instead of debiting trade inventories, we debit purchases with 8,500. Purchases is an expense and it appears in the statement of profit or loss. The second transaction we're going to look at is recording the sale of inventory. The scenario is as follows. On 7 June 2020, FAC, a registered VAT vendor, sells trade inventories for cash. The sales price is 14,662.5 Namibian dollars, including VAT. The cost of the trade inventory sold was $8,500. You are required to recognize the transaction in the General Journal of VAT for the month ended 30 June 2020 using the perpetual inventory system as well as the periodic inventory system. Since the amount is inclusive of VAT, to calculate the VAT amount, we have to use the VAT fraction formula, whereby the VAT amount is equal to the amount times R divided by 100 plus R. In this instance, R is equal to 15%, as this is a standard rated supply. Therefore, the VAT amount is the purchase price or the sales price, which is 14,662.5 times 15 over 115, which gives us an amount of 1,912.5. To calculate the sales amount, you can deduct the output VAT from the total sales price inclusive of VAT, or you can use the VAT fraction formula, whereby the sales value is equal to the inclusive amount times 100 divided by 115. Therefore, the answer that you get for the sales value exclusive will be 12,750. Thus, the journal entry to record the sale of inventory is to debit bank with 14,662.5 as bank is an asset, and this is the full amount that we're going to receive, 14,662.5. Output VAT will be credited with an amount of 1,912.5 because output VAT is a VAT on sales. Output VAT is also credited because it is a liability, as we have to pay it to the receiver of revenue. Finally, we credit sales with an amount of 12,750. Sales is credited because sales is an income, and income increases on the credit side. The general narration is sold for cash. Under the perpetual inventory system, an adjustment has to be made to inventory each time inventory is bought or sold. Therefore, a journal entry is recorded or passed to record the movement of inventory. The journal entry will be to debit the cost of sales with the cost price of inventory, which was $8,500 Namibian, and credit trade inventories with 8,500 Namibian dollars. Cost of sales is an expense and it appears in the statement of profit or loss, while trade inventories are assets and they appear in the statement of financial position. Your journal narration would be to recognize the cost of trade inventories sold. To record the transaction under the periodic system, only the first journal entry will be passed. Cost of sales will only be affected at the end of the period after a stock count. Therefore, the cost of sales journal entry is not passed under the periodic system. The third transaction we will look at is accounting for expenses incurred on credit. The scenario is as follows. On 10 June 2020, FAC, a registered VAT vendor, purchased stationery for $4,600 from Denu Stationers. The invoice was paid on 17 June 2020. You are required to recognize the transaction in the General Journal of FAC for the month ended 30 June 2020. To record the purchase of stationery at 10 June 2020, we debit the stationery account with $4,000 as stationery is an expense and it increases on the debit side. Further, we debit input VAT with an amount of $600 as input VAT is VAT on purchases. Finally, we credit payable Danu stationers with an amount of 4,600, as this is the settlement amount and Danu stationers is a liability and liabilities increase on the credit side. Finally, the journal narration is recognize the purchase of stationery on credit and the resulting payable. At this point, you would have noticed that the value of a receivable or the value of a payable or the amount paid or received is always the amount that is inclusive of VAT, while the expense amount incurred or any income earned as well as the value of an asset bought or sold is always an amount exclusive of VAT. To record the payment to Danu stationers on 17 June 2020, we debit payable Danu stationers with the settlement amount of 4,600. We then credit bank with the same amount. Payable Danu stationers is a liability, thus it decreases with the debit entry, while bank is an asset and it decreases with the credit entry. Both accounts appear in the statement of financial position. There is no VAT applicable on the settlement of a payable. Your journal narration will be de-recognize the payable due to settlement. The fourth transaction we'll be looking at is the sale of inventory on credit. The scenario is as follows. On 7 July 2018, FAC, a registered VAT vendor, sells trade inventories to NAST Ltd. The sales price is 14,662.5, including VAT. Assume that FAC uses the periodic inventory system. You are required to journalize the transaction in the General Journal of FAC for the month ended 31 July 2018. The journal entry to record the sales transaction on 7 July 2018 is to debit the receivable NAST Ltd with the full settlement amount that FAC will receive, the amount of 14,662.5. We're going to credit output VAT with an amount of 1,912.5. We credit output VAT because this is VAT on sales, as well as because output VAT is a liability. Finally, we credit sales with an amount of 12,750. The journal narration is recognize trade inventories sold on credit. The fifth transaction we'll be looking at is writing off of credit losses or bad debts. The scenario is as follows. After numerous attempts to collect the outstanding debt of NAST Ltd, FAC decided to write off the amount of Namibian dollars 14,662.5, including VAT, as irrecoverable. The owner of FAC authorized the write-off on 30 June 2019. You are required to recognize the transaction in the General Journal of FAC for the reporting period ended 30 June 2019. To record the credit losses written off on 30 June 2019, we debit credit losses with an amount of 12,750. We debit credit losses because credit losses is an expense and it increases on the debit side. Further, we debit our input VAT and then we credit our receivable NAST Ltd. We credit the receivable NAST Ltd with an amount of 14,662.5 Namibian dollars because receivable NAST Ltd is an asset and assets decrease on the credit side. The journal narration will be recognizing credit losses written off and derecognition of receivable NAST Ltd. The receiver of revenue allows input VAT in respect of the credit losses expense to be claimed back, as previously output VAT was paid in respect of the sale, but FAC did not actually receive the proceeds from the sale. By allowing input VAT to be claimed back, it is set off against the output VAT that would have previously been paid. The sixth transaction that we'll be looking at is the recoupment of credit losses written off as irrecoverable. In other words, bad debts recovered. The scenario is as follows. On 1 June 2020, FAC entity received an electronic deposit of 11,730 Namibian dollars from Chancellor, the liquidators of NAST Ltd. The liquidation distribution is 80 cents in the dollar. You are required to recognize the transaction in the General Journal of FAC for the reporting period ended 30 June 2020. To record the credit losses recovered on 1 June 2020, we debit the bank account with an amount of 11,730 because this is the amount that we are going to receive. And we debit bank because bank is an asset and assets increase on the debit side. Further, we credit output VAT with an amount of 1,530 and we credit credit losses recovered or bad debts recovered with an amount of 10,200. We credit the bad debts recovered account because it is a reduction of the bad debts expense account. The journal narration will be recognized liquidation dividend in respect of NAST Ltd's previously written off debt. The receiver of revenue deems that a supply has taken place in the instance where there is a recoupment of a debt previously written off as irrecoverable. Thus, VAT output has to be recognized. The seventh transaction deals with the withdrawals of trade inventories by the owner. The scenario is as follows. On 1 June 2020, the owner of FAC entity withdrew trade inventories worth 20,000, excluding VAT, for personal use. You are required to recognize the transaction in the General Journal of FAC for the reporting period ended 30 June 2020 using the perpetual inventory system and using the periodic inventory system. Drawings of trade inventories by the owner on 1 June 2020 will be recorded as follows under the perpetual inventory system. We debit drawings with an amount of 23,000. We debit VAT output with an amount of 3,000 and we debit the trade inventories with an amount of 20,000. Your journal narration will be recognized trade inventories withdrawn by owner. Let us look further at the amounts that we have used. We have used 20,000 because this was the cost price of the inventory. An inventory is always shown at the price excluding VAT at initial recognition. So why do we have VAT output of $3,000? The receiver of revenue deems the withdrawal of trade inventories as a taxable supply, and thus output VAT has to be levied on that supply. The reason for levying output VAT is to offset the input VAT that would have initially been claimed when the goods were purchased. Thus, the VAT output amounts to 3,000 and the trade inventories amounts to 20,000. Therefore, in order to balance the two sides, the drawings will amount to 23,000. Alternatively, you can use the VAT fraction formulas in order to calculate the value of drawings and the value of output VAT. To record the withdrawal of inventory under the periodic inventory system, the same steps are used as under the perpetual inventory system, but trade inventories will be replaced by the purchases account. The figures will remain the same as under the perpetual inventory system. The eighth transaction we'll look at is the purchase of goods for entertainment. On 1 June 2020, FAC purchased refreshments for use in the staff cafeteria to the value of 805 Namibian dollars, inclusive of VAT. You are required to recognize the transaction in the General Journal of FAC for the reporting period ended 30 June 2020. The purchase of refreshments on 1 June 2020 will be recorded as follows. Debit entertainment with the full amount of 805 Namibian dollars and credit bank with the same amount of 805 Namibian dollars. Input VAT on entertainment expenses may not be claimed from the receiver of revenue. Thus, the input VAT will form part of the cost price of any entertainment expense. The journal narration will be recognized entertainment expense in respect of staff. Finally, we move on to the VAT Control Account. The VAT Control Account is a memorandum account or a temporary account that is used to calculate the net amount that a business should pay to or claim from the receiver of revenue. If output VAT is greater than input VAT, VAT is payable to the receiver of revenue. However, if input VAT is greater than output VAT, then VAT is claimable from the receiver of revenue. The VAT Control Account, as it appears, is a general ledger account. Let us look at an example using the VAT Control Account. On 1 June 2020, the following balances appeared in the records of FAC entity. Input VAT amounted to 224,000 Namibian dollars, while output VAT amounts to 314,000 Namibian dollars. You are required to prepare the VAT Control Account for FAC for the reporting period ended 30 June 2020. And finally, you are required to present VAT in the Statement of Financial Position of FAC entity as at 30 June 2020. To record input and output VAT in the VAT Control General Ledger account, we have to consider what type of elements input and output VAT is. Input VAT is an asset, and thus it's recorded on the debit side because it can be claimed from the receiver of revenue. Output VAT is a liability, and it has to be paid to the receiver of revenue. Thus, it is recorded on the credit side. The difference between the two accounts is 90,000 Namibian dollars. Thus, we know that this account has a credit balance because the credit side is bigger than the debit side. In this instance, we now know that the output VAT is greater than the input VAT. Thus, in order to record this transaction, we know that it is a liability. 90,000 has to be paid over to the receiver of revenue. Thus, in the Statement of Financial Position, this will appear under Trade and Other Payables as a liability, and the amount is reflected as 90,000. The way forward. To ensure you have a good understanding of value-added tax, study Chapter 8 in your prescribed textbook and do the questions on value-added tax in the question bank.